Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the outlook for New Zealand interest rates in the wake of some worrying data this week. We'll take a look at Westpac's latest announcement on interest rates, and we'll study some figures that most people ignore but that really matter for homeowners and interest rate watchers. Firstly, let's consider the interest rate outlook in New Zealand after some key data on wages and employment came out this week. It's important because the balance of opinion has shifted more towards a rate hike later this year than a rate cut. The interest.co.nz consensus view on official interest rates in New Zealand is that the official cash rate is on hold for now at 8.25%, but that the risk of a change later in 2008 has shifted more towards a rate hike than a rate cut. Data on Tuesday showed record annual wage inflation of 3.4%, and on Thursday we saw the seasonally adjusted unemployment rate at a record low of 3.4%. This is reinforcing fears about inflation pressures. The wholesale money markets are currently predicting that the official cash rate will be 8.5% within 90 days. Wholesale interest rates for the 2-year swaps market have also risen 20 basis points or so in the last couple of days. This is the wholesale rate that all banks base their all-important fixed-rate mortgages on. Early in January, 3 of the big 4 banks tried to lift the 2-year fixed-rate mortgage by 20 basis points to 9.6%, and they blamed the higher wholesale rates for it. But when ASB and Kiwibank balked at the big increase, the banks had to drag that rate back down to 9.5%. But will this latest increase in wholesale rates start some banks asking questions about whether they need to hike their fixed-rate mortgage rates again? However, the Reserve Bank of New Zealand will be swimming against the trend in the Northern Hemisphere if it does hike rates later this year. The Bank of England cut its benchmark official interest rate by 25 basis points to 5.25 on Thursday. Now this increased New Zealand's interest rate advantage over Britain to 3%. The Bank of England said Britain's economy was slowing and credit conditions had tightened. Also in the north, the European Central Bank reversed its view on the outlook for its monetary policy. ECB President Jean-Claude Trichet signalled he was open to the idea of cutting interest rates in the Eurozone for the first time in 5 years. As recently as last month, ECB was saying the risks of inflation outweighed the risks of a recession, and it was hopeful that growth in Asia and Europe would be enough to cushion the impact of slowing US growth. But in the south, expectations of a rate hike to 7.25% in Australia have firmed up in the last week since it increased official interest rates. That would make New Zealand's official cash rate only 1% above the Australian rate. But it would reinforce the view of international investors that the Australasian currency bloc has a wide interest rate advantage over falling rates in Europe and the United States. It would, in theory, also give Reserve Bank of New Zealand Governor Alan Bollard some company if he decided to raise rates here. Bollard has said too he is watching Asia and Australia particularly closely. Just briefly on the interest rate front, we have news from Westpac that is withdrawing its 2- and 3-year capped rate mortgages. Now these capped rate mortgages were designed to drop their interest rate if the variable mortgage rate dropped, but not increase beyond the cap level if those variable rates did increase. The 2- and 3-year capped rate mortgages were set at 10.4% before their withdrawal. Now that compared with regular fixed rate mortgages on 9.5%, so quite a premium there. The withdrawal suggests that there were few takers for a higher interest rate for 2- and 3-year capped rate mortgages, when many now see it as unlikely that variable rates will be below 9.3% in 2 or 3 years. Westpac's variable floating rate mortgage is currently 10.55%. And you can find a full comparison of Westpac's rates and its competitors on our mortgage rates table on interest.co.nz. And finally, we look at fresh numbers out on population growth, and they're very interesting for anyone owning a house. Our total population grew just under 1% in 2007, which was the lowest growth rate in 7 years. This was largely because of a slump in net migration to just 5,500 for the year, which was also the worst number since 2000. Interestingly, there was the biggest surge in natural population growth, which means births over deaths, in more than 10 years. We have a baby boom going on. Our fertility rate in the September quarter was the highest in 16 years. But this overall slide in population growth reinforces the problems faced by the property and construction sectors, which are heavily dependent on net migration. They will, however, give the Reserve Bank some comfort in its fight against inflation. And finally, one information factoid to consider. There are now 55,000 more women than men between the ages of 15 to 65. That's the man drought going on there. Not sure what that means for productivity and economic growth, but it's interesting nonetheless. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Monday.